If you're over 65 and you have money sitting in a bank account right now, there are rules in place in 2026 that directly affect how that account is monitored, when it can be restricted, and what the bank can and cannot do without asking you first. Most people in retirement have never been told how these rules actually work, and that gap in knowledge is exactly what causes the kind of financial disruptions that catch people completely off guard. I'm Margaret Wells, and this channel is where I break down the banking and retirement finance rules that affect people over 65 in plain, honest language. Today, I'm going to walk you through the most important banking rules you need to understand this year, why they exist, how they show up in real life, and what you can do to make sure they work in your favor rather than against you. If this sounds like the kind of thing you want to stay on top of, subscribe right now because I cover one of these topics every week, and this video is one of the most comprehensive I've put together on this subject. Let's get into it. The place I want to start is with a rule that most people have never heard by name, but that touches nearly every bank account in the country, including yours. It falls under what regulators call the Bank Secrecy Act, which is a federal law that requires financial institutions to monitor customer accounts for unusual activity and report certain transactions to the federal government. This law has been in place for decades, but the way banks implement it has changed significantly in recent years, and the monitoring systems they now use are far more sophisticated than what existed even 5 or 10 years ago. What that means for you in 2026 is that your account is not just a place where money goes in and out. It is a continuously monitored data stream, and anytime your behavior changes in a way that the bank system doesn't recognize as matching your normal pattern, a flag can be generated that triggers a human review. This isn't cause for alarm on its own, because the system generates flags all the time, and the overwhelming majority of them are reviewed and dismissed quickly. But it becomes relevant to people in retirement for a specific reason. The financial pattern of a retired person looks very different from the pattern of a working person. And when someone retires and their pattern changes, those changes can look unusual to a system that learned the old pattern over many years. Your regular employer direct deposit disappears. Your income starts coming from different sources on different schedules. You might withdraw larger sums for travel, home repairs, or medical expenses. You might wire money to family members more often. You might use cash more or use certain payment methods differently. None of those things are wrong or suspicious, but they represent a genuine shift in your account's fingerprint, and understanding that the bank's system is always comparing your current behavior to your historical pattern is the first step to understanding why the rules in this section matter for you specifically. Here is where the practical impact becomes real. If your pattern changes enough to generate a compliance flag, a bank employee reviews your account. Most of the time, that review ends there, but in some cases, the bank may reach out to ask you about a specific transaction, or they may place a temporary hold on a disbursement while they complete a review. Under federal guidance and the rules that have been tightened in recent years, banks also have the authority and, in some cases, the obligation to contact a designated trusted contact person on your account. That's a person you nominate in advance, not someone who can access or move your money, but someone the bank can reach out to as a reference point if they have a concern and can't easily resolve it. Setting up a trusted contact is one of the single most useful and underused banking steps available to anyone over 65, and I want to explain exactly how you do that right now rather than saving it for later, because it's simple enough to handle in one phone call and important enough that it shouldn't wait. Call your bank's main customer service number, the one on the back of your debit card or on a recent statement, and tell them you want to add a trusted contact to your account. They'll ask for that person's name, phone number, and relationship to you. That's it. The trusted contact cannot access your account, withdraw money, or make any decisions on your behalf. They are simply a name the bank can call if they have a concern they can't resolve by reaching you. Having that name on file means the bank has somewhere productive to go if something flags rather than going straight to a restriction. It's a 5-minute call that can prevent a very stressful situation down the road. The second major banking rule that affects people over 65 in 2026 is tied directly to a law called the Senior SAFE Act, which was passed by Congress in 2018, but whose real-world effects have grown steadily more visible in the years since. Here's what that law does. It gives bank employees and financial institution staff legal immunity when they report suspected financial exploitation of a senior customer to the right authorities, as long as those employees have received proper training. Before this law existed, bank staff who suspected a customer was being exploited had a difficult choice. Say something and risk a lawsuit for breaching customer privacy, or stay quiet and watch something potentially harmful unfold. The Senior Safe Act removed that barrier. Banks now have strong regulatory encouragement to train their staff, identify potential exploitation, and report it. And the practical result is that the bar for what triggers a report or a temporary hold on a suspicious transaction has been lowered compared to where it was before 2018. What this means for you in 2026 is that a well-trained teller or banker is genuinely watching for your well-being in a way that previous generations of bank staff simply weren't empowered to do. That's mostly a good thing, because elder financial exploitation causes billions of dollars in losses to older Americans every year, and the vast majority of people who benefit from this rule benefit because a flagged transaction actually was a scam or an exploitation attempt they didn't recognize. But it also means that some transactions that are completely legitimate will occasionally get a second look. A large transfer to a new recipient, a wire to an unfamiliar account, a cash withdrawal that's larger than your typical amount, any of these might prompt a quiet check-in from your branch. If that ever happens to you, the right response is simple. Don't get defensive. Explain clearly what the transaction is for, and if the bank asks for documentation on a large payment, providing it isn't a burden on your privacy, it's the fastest way to get your transaction processed without delay. Drop a comment below and let me know, did you already know about the Senior Safe Act before today? I find that most people haven't heard of it by name, even though it directly affects how their bank handles their account. And I'm curious how many people watching this are encountering this information for the first time. The third rule I want to cover is one that has gotten more attention in 2026 than in previous years, and it involves how banks handle identity verification in an era of rapidly increasing digital fraud. Every bank operating under federal oversight is required to maintain what regulators call a customer identification program, meaning they have to verify who you are not just when you open an account, but on an ongoing basis as their compliance requirements evolve. In 2026, digital fraud has reached a scale that has pushed banks to update their verification requirements more frequently than they used to. And that means more customers are receiving requests to re-verify their identity, update their documentation, or confirm their contact information through an official channel. Here is where people over 65 run into a specific and frustrating problem. The communications banks send for legitimate identity verification look remarkably similar to the phishing scams and impersonation fraud that seniors are specifically warned about. You're told by every fraud awareness program to never click links in emails claiming to be from your bank, to never give your account number over the phone to an incoming caller, to treat unexpected financial requests with suspicion. All of that is good advice. But it creates a situation where a completely genuine request from your actual bank can be mistaken for a scam and ignored, and ignoring a legitimate verification request long enough can result in the bank restricting your account or eventually closing it for unverifiable status. The solution to this conflict is not to start trusting every email or letter that claims to be from your bank. The solution is to develop a specific habit. Anytime you receive a letter, email, or call about your account that you didn't initiate, do not respond to it directly. Instead, contact your bank through a number you already have on file, the number on the back of your card, or on a recent paper statement, and ask them whether a verification request was sent. If it was, you handle it through that call. If it wasn't, you've just successfully avoided a scam. That one habit protects you from both failure modes. Let me give you a picture of what the wrong version of this looks like. Imagine a 74-year-old retired nurse who receives an email from what appears to be her bank, asking her to verify her identity by clicking a link and uploading a copy of her driver's license. She's savvy, she knows about phishing scams, and she decides not to click anything. She also doesn't call her bank to check. because the email felt suspicious and she doesn't want to engage with it at all. What she doesn't know is that her bank had sent a real verification request because the platform was updated and all customers needed to reconfirm certain details. The email was legitimate, but because she didn't respond and didn't follow up, her account gets flagged as unverifiable after several more notices go unanswered. Her debit card stops working on a Tuesday morning while she's trying to buy groceries. That is the exact gap between good instincts and one missing step, and it's entirely preventable. Now, let's talk about a rule that affects a different kind of account situation, and this one involves joint accounts and the specific complications they create under 2026 banking regulations. A lot of people in retirement have added a family member, often an adult child, to their checking or savings account so that person can help pay bills, make deposits, or handle things if a health situation makes it harder to manage money day to day. That is a completely reasonable arrangement, and in many families, it works without any issue. But there are banking rules that apply to jointly held accounts that many people don't fully understand. And in 2026, those rules have implications worth knowing. The first implication is that any activity a joint account holder makes is visible and monitored the same way your own activity is. If your son or daughter is added to your account and they begin making transactions that look unusual compared to your account's historical pattern, the account monitoring system doesn't automatically know that those transactions are coming from a different person. It sees unusual activity. Depending on the nature of the transactions, that can trigger the same kind of review we talked about earlier. In a small number of cases, banks have used activity by a joint account holder as part of the basis for restricting or closing an account, particularly when that activity looks consistent with the patterns associated with financial exploitation. Again, most of the time this works correctly, and when a joint holder's activity really does look exploitative, the bank is doing the right thing by flagging it. But if you've added someone to your account and they have different spending patterns or regularly make transfers you weren't aware of, that could create friction you didn't anticipate. The second implication involves what happens to a joint account when one holder dies. Under most joint account structures in the United States, the surviving account holder automatically becomes the sole owner of the account balance under a right of survivorship arrangement. This means the money doesn't go through probate and doesn't require a court order to access, but it does require notifying the bank, and that notification has to go through the right process. If a bank becomes aware that one joint holder has died, some institutions will temporarily restrict the account while they process the ownership transition. If you've had a spouse or partner pass away recently and your joint account has been restricted, this is likely why. And the solution is to contact your bank directly with a certified copy of the death certificate to start the transition process. Here's something I want to be honest with you about because I think it's more useful than giving you a perfectly simple story. The banking rules we're covering today are not designed to make your life harder. They were built in response to real and documented harms, billions of dollars in elder fraud losses, sophisticated scam operations that specifically target people in retirement, and decades of financial exploitation that went unchecked because banks didn't have the legal framework or the training to intervene. That context doesn't make it any less frustrating when something you did completely legally ends up triggering a hold or a review. But understanding the system's intent helps you work with it rather than against it, because the people who run into the fewest problems with these rules are almost always the people who have the clearest, most current relationship with their bank. Staying subscribed to this channel matters here too, because these rules are updated, expanded, and amended on a regulatory calendar that doesn't always make the news. When something changes that affects how your account works after 65, I want to be the person who explains it to you in plain language before it becomes a problem, not after. The fifth area I want to cover in 2026 is the growing set of rules around digital banking access and what happens when someone can't use or doesn't want to use online banking. Banks across the country have been steadily shifting more of their services to digital platforms, closing physical branches, reducing teller hours, and routing routine requests through apps and websites. Federal banking regulators have raised concerns about this trend and its impact on older customers, and some states have passed laws requiring banks to maintain certain in-person service options. But the federal level consumer protection rules around digital access are still evolving, and in 2026, there is genuine unevenness in how well different banks serve customers who prefer or require non digital banking. What this means practically is that if you rely on in branch banking, you may find that certain account features or services are harder to access without using the bank's online portal. And in some cases, requests that used to be handled over the counter now require an online verification step that the branch can't complete for you. If that's frustrating, it's worth knowing that you do have options. You can request that certain account features be handled in person and documented accordingly. You can ask your branch manager what services are still fully available without a digital login. And if a bank is requiring you to use digital tools you're not comfortable with in order to access services you're entitled to, the Consumer Financial Protection Bureau is the right place to file a formal concern. The CFPB tracks these kinds of accessibility complaints, and they do inform how regulators pressure banks to maintain non digital service pathways. It's also worth knowing that some states have passed legislation specifically protecting older customers' right to non digital banking access, requiring that banks maintain phone and in person service channels for certain account types. If you live in a state with those protections, your bank is legally obligated to serve you through those channels, regardless of how aggressively they're pushing their app and online portal. If you're not sure whether your state has these protections, a quick call to your state banking regulator, which is usually listed on your state government's official website, can tell you what rules apply to your institution. And if you find that a bank is making non digital access genuinely difficult in a way that affects your ability to use your own money, switching to a community bank or a credit union, which tend to maintain stronger in person service cultures than large national institutions, is always a legitimate option worth considering. Let's do a quick recap of everything we've covered. In 2026, the banking rules most likely to affect people over 65 fall into five main areas. First, the Bank Secrecy Act monitoring system means your account is continuously compared against your own historical pattern, and retirement-related changes in your financial behavior can trigger flags that result in review or temporary holds. Second, the Senior Safe Act gives bank staff both the training and the legal protection to report suspected elder exploitation, which means a legitimate but unusual transaction may occasionally get a second look. Third, updated customer identification program requirements mean banks are sending more identity verification requests than before, and the risk of ignoring one of those requests, even if it looks suspicious, is that your account may get restricted. Fourth, joint account arrangements carry their own set of rules around monitoring and survivorship that are worth understanding clearly before an issue arises. And fifth, the ongoing shift to digital banking is creating access friction for customers who prefer or require in person service, and federal consumer protections in this area are still catching up to how fast the industry is moving. I want to say something directly to anyone watching this who feels like the banking system has become harder to navigate than it used to be. You're not imagining it. The rules are more complex, the monitoring is more active, and the shift to digital has left some real gaps in how older customers are served. This channel exists in part because that complexity deserves a plain language translation, and because the information that actually helps people protect their finances is too often buried in regulatory documents and compliance language that nobody outside the industry is expected to read. What I can't do is tell you exactly how any of this applies to your specific account at your specific bank in your specific state, because that depends on details I don't have and variables that change by institution. What I can do is make sure you walk away from every video here with a clearer picture of how the system works and where the levers are that you can actually pull. If you found this useful, please share it with someone over 65 who does their banking without fully understanding how these rules work. That's exactly who this content is made for. And a share costs you nothing, while it could genuinely help someone avoid a disruption to their finances. And leave a comment below telling me which of these five areas surprised you the most, or whether there's a specific banking situation you've run into that you'd like me to dig into in a future video. Those comments are the most direct way you can tell me what to cover next. I'm Margaret Wells. Coming up next, I want to get into exactly what documents every person over 65 should have updated and on file with their bank right now, because there are three specific things that make a real difference in how smoothly things go if your account is ever flagged, restricted, or if something happens to you and a family member needs to step in. That's the next video, and it's a short one, maybe the most actionable thing I'll make this year. I'll see you there.